Good evening, everyone, and welcome to the latest installment of AAII's Webinar Wednesday series. My name is Wayne Thorpe, tonight's moderator and the senior financialist at AAII. The American Association of Individual Investors is a nonprofit investment education membership corporation that, for more than 40 years, has been promoting a mission of helping individual investors become better managers of their assets through educational programs, research, publications, and software. These webinars are a natural extension of AAII's educational mission and allow us to reach a global audience. 2020 has been anything but predictable or routine, but with the days ticking away until 2021, it's not too late to take stock of your financial situation and make some tax-savvy moves. Tonight, I have the pleasure of introducing our presenter, Charles Rotblut, the editor of the AAII Journal. For the last several months, Charles has been creating an individual investor wealth building process to provide a framework for developing and implementing a personal financial plan. Tonight, Charles will walk us through some of the elements of this wealth building process, specifically how it pertains to financial planning steps and portfolio review considerations we should be making before the end of the year. So, without further delay, let me introduce Charles Rotblut. Good evening, Charles.
Good evening, Wayne. Good to see you online. Shame it's not in person, but at least we're being safe.
Well, it's actually 9 months ago today was the last time I set foot in the city of Chicago. So I can only imagine the layer of dust that is in my office.
Likewise.
And you know, Charles, I don't want to put too much pressure on you, but a little birdie told me that the number of registrations we have for tonight is among the highest we've had in the 9 months we've been holding these events.
You know, I think it has to be because you're emceeing. That's got to be the reason.
Yeah, I didn't want to say it, but I think that's, yeah, I even busted out my cool shirt for tonight. So yeah, I wanted to look the part, but with so many people signed up to hear you dispense your wisdom, though, Charles, I think it's probably best to turn things over to you. But I will be back later on to ask some of the questions that viewers have submitted. But with that, take it away, Charles.
Thank you, Wayne. Thank you, Ryan. Thanks everybody for joining us. Great for you all to be here for our final live webinar of the year. I'm going to talk about a wealth building process, and particularly some of the year-end steps you can take from a financial planning standpoint to really set yourself on a good footing heading into 2021, which I think we all hope and pray will be a lot less eventful than 2020 has been. And so the other reason we're bringing this up is the end of the year is always a good time just to do a comprehensive review of where you're at. There's nothing necessarily magical about the end of the year. You can certainly circle another date on the calendar, but it's easy to remember it's near the end of the year I need to do certain things. And you're also likely gathering some records for your taxes or thinking about the fact that you'll have to start addressing taxes after the new year starts. So there is a calendar reason for doing it as well. And in our wealth building process, which we've been unveiling over the course of this year, as Wayne said, at the very last step, the fifth step in our 5-step process is monitoring. And it really is two things. It's reviewing where you are in terms of your life, family, but also looking at your portfolio. So we're going to focus on this last step to toward the end of the year. It's important because changes on either side of those are signs that you might need to alter something, really have you go back through the other steps in the process. So even though this is a 5-step process, the idea is not you start step 1, you get to step 5 and you're done. You actually use 5 steps as a signal to say, do I need to go back and revisit one of the earlier steps? So this is not meant to be a one and done process. It's really meant to be a living process so that your investment strategy and really your investing plan evolves as you do and as your family does. So we're going to start with estate planning. And the one thing I will say about estate planning is that problems occur when your heirs and your loved ones don't have all the answers. And really your goal is to have all the important questions answered before they need to be answered. Because if you don't, a lot of unexpected things can happen. And certainly there can be events or outcomes that occur that you may not wish them to occur. So a lot of you spend a lot of time shoring up your finances, saving, managing your portfolios, but to protect your legacy, to make sure that your final wishes are carried out in the way you want them to be, it's really important to focus on estate planning and not to overlook some of the details involved with it. And so one of the things in terms of our monitoring process with the wealth building process, really in our toolkit, is an estate planning inventory. And here's an example for a couple with 2 kids. And it's really listing what key documents they have, what professionals they work with. I also added in doctors and life insurance policies. So the way to think about this is, if you were to hand over a single document to your spouse, to your loved ones, to somebody you trust to step in and be the executive of your estate, what information would they need? What information would they need to be able to execute your plan? Would they know what accounts you have? Would they know where, say, your will, your trust documents are located? Should you fall ill suddenly, would say you need your children to step in on your behalf, would they know what medical professionals to contact or what CPAs to reach out to? So the idea is to just have it all documented in one place so that the people who need this information have it, particularly when something happens that nobody expects and they need to act quickly on your behalf. And so what should go in this inventory? Well, think about your key accounts, your policies, your pension. If you served in the military and you plan to be buried in a military cemetery, you'll need your military ID. But you also want to think about things like, where's your house, your auto titles. Do you have final wishes? Maybe there's certain people you'd want to be notified. Maybe there's a certain type of ceremony you want. Maybe there's something you don't want to have happen. Really think about your heirs and, again, your trusted contacts. Again, going back to this question of what do they need? And I realize nobody wants to think about their final days. And the reality is we're all one day closer to proving we're immortal. But just in case physically we're not immortal, you want to have these plans and really have them set up so, again, your final wishes are carried out in the way you want to. And this ties into investing because many of you might be hoping to leave an inheritance, or perhaps there's a cause or charity you want to leave money to. So if that's your goal, think about, how do I ensure this happens and how do I smooth that process? And taking care of these things, even though they might seem like minor details, can have a really big impact. And I speak from this from a personal standpoint because this really helped me personally. And some of you might have seen this. About 3 years ago, my father-in-law passed. He had cancer. And after his diagnosis, one day I just sat in the house with him. I said, Les, can you show me where all your documents are? And I literally followed him around the house with a notebook in hand. Now, like a lot of people, my father-in-law knew where all his documents were. And he had them so organized. The problem is that some of his brokerage statements were in his office in a filing cabinet. His military ID, he served in the Army, was in the bedroom. The title to the house's automobiles were in a safe deposit box. He knew exactly where everything was, and it was easy for him to find those things. My wife and I, we didn't have a clue. But because I took the time and because I walked around the house, literally with a notebook in hand, scribbling down notes, the day he passed, I was able to sit down with my mother-in-law at a table, pull all the documents, and we got on the phone, we just started making calls and got the ball rolling to ensure that if you have this inventory created. And as you're going through this, think about your life and think about your family. Has anything changed that might warrant you revisiting your goals or possible documents? And here's an example for a couple with a newborn daughter. In this case, they'd want to think about, notifying godparents if they have godparents, updating their wills. If they don't have trustees, perhaps overseeing their kids' finances should something happen to them. We know, my wife and I know a young couple that unfortunately died in a car accident with 2 very young children. You hate to think about these things happening, but they can happen. And so the idea is just go through your family. Was there a divorce? Did someone, someone got married? It can be or did somebody pass? It can be a positive or negative event, or perhaps in your life. Maybe you're fortunate enough to sell business, or something else happened where you came into a large amount of wealth. Or unfortunately, maybe the opposite happened and there's a negative change in your financial situation. Just take the time to walk through this and think through these things, and then stop and ask yourself, does this change my goals? Does this change something in my estate documents? Does this change something in my financial documents? It won't take you very long to go through this, but this prompt can actually remind you that you need to take care of certain things, and again, avoid unwanted consequences. Sometimes in investing, we get very complicated, but often these very simple things are really important and really powerful actions to take. So again, think about your life. What has changed over the last 12 months? Does it prompt you to do anything? And part of the reason we say this is it can have really big impact. So this is a dispatch we ran several years ago, and it was about changing beneficiaries. So what happened was, the gentleman died. He had called his HR department and said, I need to change my beneficiary. But all he did was call, and he never changed it. In this case, his ex-wife was left as a beneficiary of his 401k, but he never signed the documents. So when his son tried to get the money left in the account, the court ruled and actually went to his ex-wife, because in this case, there was never signed documentation of the beneficiary changing. And now the court also said that he kept conversations with his wife, so it was added things there. But again, if maybe there's a divorce in your family, hopefully not, but if it happens and the ex-spouse is listed on your documents, perhaps you don't want the ex-spouse listed. Or again, perhaps there's somebody you want to be added as a beneficiary. So just taking the time to go through those documents and just go through your accounts. Are the beneficiaries correct? If there's fiduciaries, are they correct? Is my will up to date? Are my trust up to date? Think about all those documents and spend that little bit of time going through them to make sure everything's good. Again, it's a matter of dotting your I's and crossing your T's. So Ryan, I do believe we have a poll here regarding into estate planning.
Absolutely. So we wanted to know of our viewers, how often do you check the beneficiary information on your accounts? Please select from at least once a year, once every few years, perhaps when there's a change, family, new account, that sort of thing, or maybe you don't change it at all infrequently, or you're not sure when the last time was. Please choose from the options. We'll leave this up for a little bit. And while we do so, Wayne, have any questions come in that we can perhaps fill the time with while people file the results for the poll?
Actually, a couple people asked, and perhaps others are thinking. Charles, how can people learn more about this wealth building process that you've been working on?
Sure, that's a great question. So on our website, we have a section called Learn and Plan. It's there's a navy blue bar near the top of every page. You'll see it right there. We actually have about 7 parts of the toolkit we've built so far. We have approximately 5 more. We're going to be adding, hopefully before Christmas. There's videos on there. There's narratives, and there's also access to all the worksheets that are part of the toolbox.
Excellent, and I'm very excited about seeing what the outcome of this is going to be. I think this is going to be a great thing for AA members. So I'm looking forward to seeing where this goes. So I'm looking forward to the next several months personally. This a little bit of a left field question. So if you don't know the answer, but a couple people are asking, with more and more people having online accounts, credit card statements, brokerage accounts, everything like that. Do you have any suggestions as far as a secure means of storing all of those online account credentials in one place? So, God forbid something happens and someone has to be able to access all of this information.
Yeah, that's a great question, Wayne. I know you're formerly editor of our computer investing publication or newsletter. I use Dashlane, which is a password manager. A big competitor to it is LastPass. I know with Dashlane, you can actually list an emergency contact with it. I don't know if LastPass does it as well, but you can actually store passwords in there. Everything's password protected, so it's pretty safe. I really like using it. If you were to hold a gun to me and ask for my password to my bank account, I literally could not tell you. It actually suggests passwords. And I do think we might have talked about those in the journal a few years ago, but I'll make sure Gene, our editor, actually has links to those. And there's a few other password manager programs out there as well, but LastPass and Dashlane are two of the biggest ones.
Excellent.
Right.
No, I think that'll be of keen interest. So Ryan, back to you.
Yeah, absolutely. So here are the results of the poll. It looks like the majority of our viewers tonight check their beneficiary information once every few years, and at 34%. And second answer was when there's a change at about 30%. Charles, does this surprise you at all?
No, it didn't. I actually did not know what the answer was. So interesting, but that's good. At least people are doing with some type of, regularity, doing it, some type of frequency. That's good. Like I said, I think it's useful to do at the end of each year, but the big thing is you want to make sure that when there's a change in your family, you're checking it, but you also just want to make sure you don't go too long, because certainly I found myself, there's situations where you thought you had everybody listed you want to have listed, and all of a sudden you realize, wait, they're not on this. I recently had that I have an account with Discover, who we have an affiliate relationship with, and I was going through it, and I was checking, I realized that my wife wasn't listed on the account. So, just part of that regular process, I happened to catch that, and we got that corrected, and she's on there now. So,
Yeah.
well, even us who talk about this sometimes catch those mistakes, and have to make sure we correct them.
And to be clear, there's no right answer here. It's just that you should check.
Yeah, absolutely. Like I said, if it's once every 2 or 3 years, that's fine. But you obviously don't want to go 10 years and realize, oh, wait, I should have checked sooner.
All right, sounds good. I will check in later with the other poll that we have prepared. So go ahead and continue with your presentation.
Great, thank you. So now we're going to get to the other part of monitoring, which is reviewing your portfolio. And it really comes down to having a plan. And when I wrote about this investor update, it was really saying on there, don't really focus on returns. Think about what you want to look at when you go in the portfolio. To the extent you can go into this portfolio review with quote unquote blinders on, the better you will be. Wayne can attest to this. When we go over our model portfolios in our virtual offices now, whether it's stock superstars, which Wayne oversees, dividend investing, which Derek oversees, VMQ, or shadow stocks, with John Bukowski oversees. I oversee VMQ. We're looking at specific metrics to determine whether or not a stock needs to be sold or not. So we're very aware of performance. We do pay attention to it, but we really let the portfolio rules guide our decisions about whether or not an action needs to be taken. And so one of the worksheets we have in the Wealth Building Toolkit is a portfolio review checklist. And I try to create this is really so it could work for a lot of different people. So the idea is you establish your own rules and you list them there. So in this example, I'm giving someone who, using RA+. And so in this case, one of the rules for whether or not a stock will be sold is that does its value grade go to an F, meaning the stocks become really expensive. So our A+ grades run from A to F. It's just like in school. A's will make your parents proud. F's will get you grounded. Same thing for stocks. A's, low valuation, or if you look at growth, strong growth. If you're looking at momentum, strong momentum. F's, high valuation, lousy growth, weak momentum, etc. In this case, they also own mutual funds. In this case, they agree that they're going to look at the mutual funds annually, and they actually have a reminder set up on their calendar. So for mutual funds, you really don't need to follow them that frequently, but you obviously want to pay some attention to them. Are they performing as well as you expect relative to their category peers? Has anything changed with the objective? But you don't need to look at a mutual fund every day or every week because you're holding them so that a professional manager makes the decisions for you. But the idea is that there is actually a date and a frequency set up on this portfolio review checklist. So you do have set times to look at your portfolio because you really don't need to look at it on a daily basis. You're going to notice a lot more volatility the more you look at it. But if you look at it less often, you'll see less volatility, but you also give your investments room to evolve. And hopefully they'll evolve in a positive manner, but you want to make sure you have those sell rules in case they don't evolve in a positive manner. So what considerations should you have when looking at the portfolio? Well, like I said before, look at only what you need to look at and ask yourself, is anything meeting a sell rule? And your sell rule should always be established before you buy the investment. So when you're buying an investment, ask yourself, what would cause me to part with this investment? You know, if you're a growth investor, it can be slow growth. If you're a value investor, high valuation. If you're using technical analysis, maybe it's a breakdown in the chart pattern. You also want to look at your overall portfolio, and you don't need to do this weekly, but perhaps once a year or perhaps every 6 months on set dates, ask yourself, does your portfolio still meet your target allocation? Now, say for instance, you're targeting 60% stocks, 40% bonds, and your portfolio is 62% stocks, 38% bonds. Well, you probably don't want to make an adjustment there. You want to allow your portfolio a little bit of wiggle room. And there isn't a set amount of wiggle room where everyone in the industry can agree this is where you draw the line. But Vanguard looked at the data when it came to rebalancing, and they suggested 5 to 10 percentage points off target for your major asset classes. So if you're targeting at 60% stocks and you're at 66% stocks, maybe that's where you draw the line and say, okay, I need to bring this portfolio back into balance. And obviously, if you're making withdrawals, you want to make sure there's enough cash available to make those withdrawals if you're planning on making a cash withdrawal from that portfolio. If you're following the level 3 withdrawal strategy, which our founder, Jim Clinton, who I'll add, for those of you who may not have heard the news, Jim unfortunately recently passed. We do have a tribute page on our website. I do encourage you to come visit it. And we'll have more about Jim coming in January. But his level 3 approach, he did suggest that when the market's within 5% of its record highs, that you not only withdraw from your growth bucket, which is basically your stocks bucket, but if you need to replenish your safe assets, which is what you withdraw cash from, you do it then as well. So if you're following that approach, end of year is a good time to actually make sure you have enough cash to actually make those contributions to your safe bucket. And again, but the big thing is, I want you to really focus on the process and really have this process that's geared to the type of investor you are, and focus on that, not on the returns. As investors, we do not get to choose the type of market conditions we live through. We don't get to choose if we live through an extended period of bull markets or if we live through a period of bear markets. You know, go back to 1920. Some people started investing in 1927. All of a sudden, hit the Great Depression. Some of you might have had to endure the high inflations of the 1970s. There's always a wall of worry stocks are going to climb on. We can't do anything about it. And as we enter a new presidential administration, we're going to hear market forecasters describe what they expect the Biden administration is going to be for stocks. But the simple reality is 4 years from now, we're probably going to be talking about different events in the markets than we're talking about now. Hopefully it'll be positive events, but the reality is we don't know. Go back 4 years ago, nobody was certainly talking about a global pandemic. So focus on the process. Are you following your rules? Are you following your strategy? And if you are, you'll get the best possible returns you can for a given strategy, dependent on obviously what Mr. Market is doing and what he's favoring over that time period. So Ryan, we have another poll questions here about our portfolio review process.
Absolutely. So we wanted to know from folks viewing tonight, how would you describe your portfolio review process? Maybe it's a structured review process. Perhaps it's not structured, but you know what to look at. Maybe you don't have a process, or perhaps you infrequently or rarely do it. Please select from the options below. And Wayne, while we wait for the results to come in, do we have any questions that we can answer right now?
Actually, Charles, put you on the spot a little bit, but I oversee a portfolio here at the association. You oversee your portfolio. Obviously, we own our own individual stocks. But I'm just curious, what methodology, what system do you have in place to help you on the sell side, making when you're selling stocks? What system do you have in place? Before you buy a stock to hold yourself accountable to make that difficult sell decision?
When it's just like we do with actually do at the office, I just have the rules in place. And so when I'm buying stocks, I know precisely what rules I'm going to use. I do actually use a VMQ strategy for my own portfolio. So I make actually use of my portfolio, which is available on AAII.com. I do eat our own clicking. I know you do as well. All of us in the office use our tools. So I actually use our grades to determine those stocks. For my longer term holdings, I write down specifically why I'm holding them, what I'm looking for. I've talked about before, I own Berkshire Hathaway. I view it as a very safe stock. And thereby I also own two winery type stocks. I own Constellation Brands and I own a small Willamette Valley Vineyards. And both of those, I bought those for the long-term prospects, for the business models. And again, I just have those things written down. So I'm very clear about why I own them. And fortunately, so far, they have not violated any sell rules.
And I think that's the key. It's, and Charles alluded to earlier, it's, knowing what's going to trigger that sell before you actually make the buy. It makes the sell decision much easier. There's no sleepless nights, no second guessing. It's you make the decision and you move on. But Ryan, are we ready for some results?
We are. So it looks like 50% of our audience tonight do not have a structured review process, and they do know what to look at, followed closely by structured at 25%. They don't have a process at 21%. Charles, what do you make of that?
Well, people obviously, they may not describe it structured, but at least they know what they're looking at. So it was interesting. When I was writing this question, I wasn't quite sure how to word the answers. So a little bit of variance on there, but no, it does sound at least that people have a plan when they're going in to look at the portfolio, which is great. You don't want to be someone who's just looking at CNBC and waiting for Jim Cramer to tell you what to do. It's good that at least people, when they engage with the portfolio, they are looking for specific metrics. So that's a good sign. And it shows that our members are, listening to what we put in the journal, what we're doing with our newsletters, and sounds like they are learning from it, which is great, because that's what we're here to do, is help empower individual investors to become better managers of their own assets.
And I guess the overall goal of the wealth building process, or one of the goals of the wealth building process, is to kind of encourage people to think about this and think about their own set of rules. Not necessarily that you need a formalized plan, but perhaps start thinking about the steps you need to review your portfolio. Correct?
Yeah, absolutely. The whole idea is just having the structured plan that defines who you are as an investor. And since it's interesting, because we are talking about estate planning and portfolio review process, once you go through the whole toolkit, the whole wealth building process, you'll actually have a document that details exactly how you invest. And it's something you can actually share with your spouse, your kids, or if you have grandkids, you can go to them and explain to them, this is exactly how I invest. Here's everything, and walk them through it. And so it's a great way for them to understand what you're doing, why you're doing it. But if you have kids or you have grandkids you're trying to get interested in investing, and you want to share with them how to do it, it's a great teaching tool. You can actually walk through the whole toolbox with them from start to finish, from your goals right down to the review process, and get them started on the right foot so they actually understand investing more and why you're doing the things you're doing. And so it can actually be a great, great family thing to do, even if you have to do it over Zoom, given the current environment.
Absolutely. Well, I look forward to the rest of your presentation, and I will check in back at the end. Back to you.
Right. Thanks, Ryan. So as far as more year-end ideas, in the current issue of the AAII Journal, December issue, we did publish an article with 17 moves you can take before the end of 2020. Some I discussed here. You'll notice on the screen where I talk about reviewing your credit reports. That's what I do suggest doing annually. And we actually have the links onto Equifax, Experian, TransUnion. You can also just go to annualcreditreport.com. It's a site recommended by Consumer Reports. You can actually you can get one free credit report per year. I tend to stagger it. So I do it every 4 months. I look at one of the 3 credit bureaus. So I'm getting a review over the course of the year. We know a lot of AAII members tend to be more affluent. We know many of you are retired. You're targets for being scammed. Even though you're good about warding them off, you are targets for being scammed. I got a call today, literally on my voicemail, saying that there's a legal matter, and that if I don't call back, I'm going to be arrested. An obvious scam, a phishing attempt. They were trying to get information from me. My phone flagged it actually as a spam call, so it went to my junk mail calls. I never got a chance to answer it, but you really just want to be on guard because these identity thieves are out there. And if you think these things can't happen to you, I can tell you I've had fraudulent transactions on my credit card. Fortunately, they've been caught. I once had someone actually steal my debit card number and make $1,600 worth of payments to Progressive Insurance. The problem is I'm with State Farm. Again, fortunately, I caught it. My bank made me whole right away. No problems asked, but the crooks are out there. And even though you might try to really take care of yourself and watch yourself, both in person, online, in my case, my debit card got probably swiped at an ATM. I only use my bank's ATM. So now I actually cover the keypad when I type in my password. Just realize they're out there, and so you do want to take precautions. And one of those precautions is checking your credit reports. I do suggest considering putting a freeze on your credit reports. You'll get a PIN number. When you go to apply for a new credit card, you apply for a loan, you will have to let the lender know that there's a freeze on my credit report. I need to unfreeze it. A little bit of a nuisance, but it does provide an added layer of protection. So the other thing is, I'll just go back to this article, real quick. This article, we do have more things on here, also financial moves you can do in terms of taxes. I will be answering more tax questions tomorrow's investor updates. But one thing I will point out, as we get near the end of the year, medical expenses. In 2020, there's a 7.5% floor for medical expenses, meaning you can, if your medical expenses exceed 7.5% of your adjusted gross income, you can deduct all the medical expenses above that level. It's supposed to revert back to 10% next year. Might be attached to a last minute bill. I don't know what's going to happen in Congress. But if you think you're close to the limits, consider about whether you can refill your prescription sooner, if there's other things you need to get to qualify for it. But we have a lot of good moves in this article. Take a look at it. As I said, it's online right now. The journal itself goes online approximately the first of each calendar month. So you can always access it first. It should be arriving in your mailboxes soon. I haven't checked the mail today, so I don't know if it's in my mailbox yet, but because of holiday mailing, it may be delayed. I'm sure some of you have had the same experience I've had with packages being delayed. So I encourage you to go online and take a look at all those 17 moves. Wayne, any questions?
Yes, actually, we've got several coming in. This might be a little too in-depth, but a couple questions out there. 2021 has caused a lot of people to dip into their strategic or liquid reserves. Do you have any general suggestions for people that are looking to rebuild those liquid reserves, maybe from equities they hold or things like that?
Yeah, I think you need to look at your allocation and again, obviously your goals. And we talk a lot more about goals in a January issue as part of the wealth building process. But think about where you're at in terms of your goals. And if it's the case you're trying to rebuild your emergency reserves, think about whether or not you need to sell your equities or can you hold them on for long-term growth and you can rebuild your short-term reserves gradually instead of all at once. I'll go back to Jim Clunen's Level 3 book. With his withdrawal strategy, he talks about pulling from cash reserves when the markets are down. And then he talks about gradually rebuilding those cash reserves over time. So if you haven't completely drained your emergency reserves, maybe think about doing it gradually. And if there's excess savings you're able to contribute to it, great. Or perhaps you're getting dividends or interest payments that you can contribute to your savings. Think about doing that gradually. If it's a case where they really got drained a lot, because I do realize this is a very tough year. My wife and I were just talking about donating to a food bank earlier this evening. You might have a choice but to think about adjusting your allocation so you do have the emergency savings. But if you're not in that situation, think about, can you do this gradually, perhaps by, again, tightening up your budget a little bit and just trying to build your savings over time.
I just want to speak, from my own personal experience. One thing that isn't thought about a lot, but if you're looking for a potential financial planning move to make, if you own your home and haven't refinanced your mortgage any recently, definitely is the time to do it. I actually refinanced my mortgage back late fall and was able to lower my mortgage rate by 2 percentage points. So saving myself about $350 a month in mortgage payments. So if you haven't refinanced over the last year or so, you're probably leaving some money on the. That'd be something to consider as well. Generally speaking, and we're getting a lot of questions in, and I don't want to frustrate people. We're getting a lot of very specific questions. And so Charles is not able to be helping people with specific tax-related questions. So we're getting a lot of questions, but if we don't cover them, that is why. It's because they are highly specific. So I'm trying to go through these questions and look for more generic type questions. We've gotten a lot of questions, Charles, though, on tax harvesting. And a few minutes, just what the concept is, what people should be looking at as we draw to the end of the year in regards to tax harvesting.
Yeah, that's a great question. I am actually talking about that in tomorrow's investor update. So tax harvesting is actually realizing a loss for tax purposes. So the rule is that short-term losses offset short-term gains, long-term losses offset long-term gains. But if your losses for either short or long losses exceed your corresponding gains, then you can carry it over to the other side. Now, you can claim a net loss of up to $3,000. And so say you harvest $5,000 with net losses, meaning after you've accounted for all your capital gains, you have total 5,000 losses you can deduct from your taxes. This year, you can only deduct 3,000. But that other 2,000 you don't lose. You actually carry it over to the following year. Now, the one thing you want to be careful about, if you're taking a loss now, you have to wait 30 days before you can buy back the substantially identical investment. So say you bought Macy's. I'll just throw out a stock at random. You bought Macy's. I actually don't know what it did this year. I don't follow it closely, but we'll say it went down because it was a tough year for retailers. You sell your shares and you still think it's actually going to be a survivor. You have to wait at least 30 days before you buy the stock again. Now, what's interesting, there is a little loophole here. So say you own an ETF, you own the SPY, which is the Spider S&P 500 fund. Probably not a great example because the S&P 500 is near record examples, but it's a very near record highs. But it's a very simple example. If you sell an ETF, technically you could buy an S&P 500 fund issued by Vanguard or an S&P 500 fund issued by iShares. So the substantially identical fund actually, a rule actually allows you to buy a similar fund issued by a different fund family. Now, to be safe, I would suggest that, say, if you sold an S&P 500 fund, maybe you buy something like the iShares US Dow Jones Index, which it holds the top 1,000 stocks, or maybe the Vanguard Extended Market ETF. So you're actually with a different ETF. But for stocks, you cannot sell the same stock and buy within 30 days, nor can you buy options. So you do want to be cognizant of that 30-day window. You could perhaps, so let's say, sell Macy's and then maybe buy a retail ETF that holds Macy's in it. In that case, you'd be okay because you're buying a portfolio that's tying into the industry group, but not the exact same investments.
Very interesting information. Thank you. I learn something new all the time when I listen to you, talk to you, Charles. You know, got a couple questions in here. You know, as an end of the year, especially with believe that there are no required minimum distributions required this year. There's a question is, you know, would this be a good time for a Roth conversion if you don't have to make those have to accept those RMDs this year?
Yes, I actually believe it's one of the 17 moves I've listed in the article. So it is, and the rationale is because you're not taking the RMD this year, you're not incurring the taxes on that RMD. So for the same amount of taxes you would have normally paid anyway, had you had to take your required minimum distribution, you can actually take that taxable amount and use it to fund the RMD. So I'll just throw out a number. Say your RMD is typically was going to be $20,000 this year. You would owe taxes on $20,000 worth of income. You could, in exchange, that you don't have to take the $20,000 out this year, you could instead use that to convert $20,000 from your traditional IRA to a Roth IRA. Now, keep in mind, you do want to pay attention to how close you are to going into a higher bracket, meaning having more of your Social Security benefits taxed, and also realize this Roth IRA conversion will impact what you pay in Medicare premiums 2 years from now. So your Medicare premiums are actually based on your modified adjusted gross income from 2 years ago. So any taxes you realize now will impact your Medicare premiums 2 years in the future. So if you're close to the current cutoffs to where you'd be at a lower premium or higher premium, you do want to keep that in mind. But all things being equal, it is actually a good time to do the RMDs if it's beneficial for you to do so.
So I think you've kind of just answered this question, but just to make sure that at least something else I'm understanding it correctly. You know, there's a question, general advice on how to decide whether converting a traditional IRA to a Roth is a good idea once you're retired. And it sounds to me what you just said was, you know, a main consideration would be the tax bracket you're in. Is that correct?
Yeah, absolutely. And the one argument for doing it when you're retired also is that you actually have less income in the future. So as your RMDs, if your RMDs rise, so say you have enough wealth where your account balance is growing over time, as your RMDs increase, you'll have more taxable income. So by converting to the Roth RMD, converting to doing a Roth IRA conversion, mixing up my acronyms here, you're actually paying the taxes now, but you don't have to pay the taxes in the future. And there's actually a school of thought that if you retire, say at age 65, but you postpone claiming Social Security benefits, or if you retire before you're required to take the RMDs, to actually take advantage of that window and do the Roth IRA conversions in that window, so that you actually have less RMDs in the future. So because RMDs are taxable income, it could actually help lower your taxes and lower your Medicare premiums in the future. I should add, when you're doing all this, also take into consideration state taxes as well, and where you're at in relation to your state taxes bracket.
Staying on the same stream of consciousness, do do you know, can you convert a 401k or a 403b into a Roth IRA?
You can actually do a direct conversion of either directly to a Roth IRA. We actually, and I'll have Gene add it to the notes. The IRS actually has a rollover table where they list each type of account and what can be converted to what, or what can be rolled over to what. I will have Gene add it to the show notes. We actually replicated 2016 or 2015. We'll find the exact article and it will be in the show notes so people can actually see the table. It's a very simple but very useful table. And I realize the words simple, useful, and IRS aren't always uttered in the same sentence, but in this case, they definitely got it right.
There the twain shall meet. Actually, you know, if nothing else, planting the seed for maybe an investor update or a journal article early next year. But James asked, you know, we've talked a lot this particular presentation about year-end planning, but are there any specific plans or steps that people should be taking at the beginning of every year? You know, maybe not answer that now, but you know, maybe something to think about for again, an investor update or something like that. But if you have anything you'd like to toss out, feel free.
Yeah, no, that's actually a great idea. I usually at the end of the year, I usually do like investor resolutions for the coming year. I will do it again this year. Probably break it up over 2 weeks because the list started off pretty short and it's grown like weeds over time. So I will have a lot of suggestions in it, but there might be some stuff from that I could actually use for a future journal article. So we always appreciate suggestions for new articles and new ideas. So thank you for the question.
You know, I've been looking through these, and I apologize, but I think a lot of these are pretty specific. So if I will maybe give us a couple more minutes if anyone has any more generalized questions that they would like answered by Charles. Actually, here's one, Charles. Do you know if you are employed, are you required to take an RMD?
That you may not be. There's specific rules if you're employed about how that works. I can get the IRS document listed in our show notes. It actually goes through that. I don't want to answer it because I don't know the specific rules as far as how that applies, but we'll definitely get that document to the IRS that explains it, the publication.
Said we've got a lot of really good questions out here, but I think they are probably a little too specific for tonight.
Hey, Charles, while we wait for a new question to come in, maybe we can give a quick plug because a lot of people have asked where they can access all this information and the worksheets and whatnot. I believe the URL for the wealth building process is AAII.com/learn-and-plan. Is that correct?
That's correct, and it will be in the show notes as well.
Great.
But as I said, if you go to any page on AAII, near the top, you'll see our navy blue nav bar, and you'll actually see it right there where it says Learn and Plan.
And those worksheets that are included as a part of that, people can fill in by themselves, correct?
Absolutely, they can fill in, they can download it, save to their computer. And as I said, there's videos on there, there's text, there's the worksheets, and we're going to pretty soon fill out the complete toolbox. So we've got about we have 7 of about 12 on the page right now, and my editors, Gina and Anine, are finishing it up. And I know Ryan, you're editing the videos to make me look a little bit smoother.
Well, hopefully not too smooth. Wait, has anything else come in?
Actually, Ryan, I got a question for you. People are asking about these all powerful and magical show notes. Where will people be able to access those?
Absolutely. So for folks who are interested in that, we are recording this webinar. It will be available on our YouTube channel tomorrow, and links to the show notes and the presentation will be included as part of that. Since you're watching and you've registered for the webinar, you will receive an email from us when that becomes available. So that will include everything that Charles has talked about, his presentation slides, and links to some of the resources we've discussed. So yeah, lots of questions. I see that. It's great that people are interested in this.
Absolutely. And actually, it looks like one last question. Charles is sort of the other side of a coin that we've talked about previously, but Murthy just asked, there's a lot of, typically we always hear about, tax loss harvesting. Is there, and other what circumstances would someone potentially do tax gain harvesting?
Yeah, really, that's a great question. Really, the idea, Tom, that, well, first of all, you always want to make sure the stock is meeting your buy rules. But if you have losses, it's great, and you're thinking about trying to maybe pare down a position, maybe position you pretty sizable gains and you want to start taking some profits in it. When you have losses, you can offset those gains. That's always a really good time to do it. And the other thing is, if you know you're in a lower tax bracket, or especially if you're near the break points for capital gains, and I will point out the brackets for determining how much capital gains you pay, whether it's 0%, 15%, or 20%, the Tax Cuts and Jobs Act actually separate those from the marginal tax brackets to determine what you get paid, say, on your salary. So if you're typically close to those brackets and you're actually below one, that's another time where it might make sense to actually start getting some of those gains. But I do encourage you to think about whether or not the stock meets your buy rules. Meets your sell rules, or obviously if it's a very large holding and you're thinking about either locking in profits or you're just thinking about more in terms of allocation, that's certainly a consideration as well.
And also, I just want to interject. Charles is extremely knowledgeable, arguably the most knowledgeable person when it comes to these topics at AAII. But at the end of the day, if you're considering making any type of tax-related move or anything like that, it's always a good idea to consult with a tax professional before doing it, just to make sure that all your I's are dotted and T's are crossed.
Absolutely, and I do want to point out that the initials after Wayne's name and my name are CFA, not CPA. At the end of the day, it's your name going on the tax return. So if you have specific questions, it can be well worth paying to spend a little bit of time with a tax professional, and certainly that cost may be well worth it to deal with them than to deal with the IRS.
We should also note that we did do a webinar last week about tax issues for 2021. You can find that on our YouTube channel, or the full archive actually at AAII.com/webinars, and people can look to that resource, as well as the tax guide that has a lot of useful information for folks looking for more information about taxes in the coming year.
Go ahead. Sorry, apologies, Charles.
No, go ahead, Wayne.
No, I was just going to say, I think we've exhausted our pool of questions for this evening. But before I sign off and turn it back to Ryan, I'd say, Charles, I don't think I've extended to you previously, but happy Hanukkah. I think you've one final two nights, correct? Tonight and tomorrow night?
2 nights, correct. Yes, we're
so
trying to make sure we have our candles correct. Thank you, Wayne, and Merry Christmas to you, Wayne. Ryan, Merry Christmas, and certainly to everybody here. Wish you a happy Hanukkah. For those of you who are observing the holidays, our Merry Christmas, and happy holidays to everyone else who's listening. We certainly wish you a much better 2021 than a 2020.
Absolutely, yes. Have a happy and safe and healthy holiday season to everyone. But throw it back to you, Ryan, for our sign off. So good night, everybody.
Great. Yes, thank you both Wayne and Charles for your time tonight. I wanted to also thank all of our viewers for watching tonight's webinar. As I said, a replay of the presentation will be available on our YouTube channel tomorrow, along with links to tonight's handout and to some of the resources discussed. This will be sent to your email address. We also do have some upcoming webinars to highlight, which you can sign up for at www.AAII.com/webinars. That includes also our full archive of webinar content that you can watch as the end of the year winds down. So we will be we'll be taking a 2-week break over the holidays from webinars. Our next new webinar will be January 6th. Unfortunately, as Charles said, our founder, James Clunan, recently passed away. And so on January 6th, we are putting on a show in tribute to him. Join us for that at 7:30 p.m. Central in 2021. And then following that, on January 13th, we'll be doing a rebroadcast starring our own Wayne Thorpe of the Making the Grade, highlighting new features of A+ Investor. This is a recent webinar that he did highlighting some of the new features of A+ Investor you may have missed. If you're interested in the product or you're subscribing to the product, you may learn something from watching that broadcast. So with that, I'd like to, again, wish everybody happy holidays. It's been quite a year, and we wish you a good health and good wealth. Good night, everybody.